Amazon is a $2.3 trillion company that operates what might be the most audacious business model ever constructed. A world-class logistics network that loses money on retail, subsidized by a cloud platform that generates $40 billion in annual operating income. The entire structure only makes sense if you understand that AWS pays for everything else.
That's the key insight investors miss about Amazon. It's not a retailer that also does cloud. It's a cloud company that happens to run the world's largest e-commerce operation as a customer acquisition strategy. AWS generated $39.8 billion in operating income in 2024, more than the entire retail segment combined.
Jeff Bezos started Amazon in 1994 in a Bellevue, Washington garage selling books online. The $18 IPO in 1997 raised $54 million for a company with $148 million in revenue and a mission to become the everything store. The skeptics who called it Amazon.bomb in 2001 didn't understand what he was actually building.
The pivot that changed everything happened in 2006. Amazon's internal IT infrastructure was so well engineered for handling peak retail demand that Bezos realized other companies needed the same thing. AWS launched S3 and EC2, and in doing so, accidentally invented the modern cloud computing industry.
Prime launched in 2005, and the economics were counterintuitive from day one. Amazon loses money on shipping for Prime members, but Prime members spend 4 times what non-Prime customers spend annually. 200 million members paying $139 a year creates $27 billion in subscription revenue before they've bought a single item.
The advertising business is the third pillar that most investors underestimate. Amazon crossed $56 billion in ad revenue in 2024, making it the third largest digital advertising platform on Earth. Unlike Google and Meta, Amazon's ads convert at the moment of purchase intent. That's the highest value ad placement in existence.
Andy Jassy took the CEO chair in 2021 when Bezos stepped back. Jassy is the architect of AWS. He literally built it from a small team in 2003 to a $12 billion business before Amazon broke it out as a separate segment. He understands the AWS profit engine better than anyone alive.
The 2024 capital expenditure plan is $84 billion, the largest in Amazon's history and one of the largest annual CapEx programs of any company globally. The vast majority is going to AWS AI infrastructure, data centers, custom AI chips, and the Anthropic partnership that makes AWS Bedrock the premier AI model deployment platform.
Let's look at the revenue picture. $638 billion in total FY 2024 revenue breaks into 3 segments. North America retail at $382.8 billion, international at $144 billion, and AWS at $114.8 billion. AWS is only 18% of revenue, but it generates the majority of operating income. That asymmetry is the whole story.
The North America operating margin recovery to 5.3% is significant. Amazon dramatically overexpanded its logistics footprint during COVID and burned through cash in 2022, getting it right-sized. The recovery to profitability with $54.3 billion in free cash flow in 2024 demonstrates that the retail business has real underlying economics when the cost structure is disciplined.
On the competitive radar, Amazon scores 95 on both cloud market leadership and logistics infrastructure, the highest in its peer comparison. AWS holds 32% of global cloud market share. The fulfillment network spans 1,100 plus centers and delivers to 200 million Prime members in 50 plus countries. These 2 assets would each be worth hundreds of billions as standalone businesses.
The global network scale is staggering. 33 AWS regions, 1,100 fulfillment centers, and 1.55 million employees, making Amazon the second largest private employer on the planet. That physical infrastructure is the moat that cannot be replicated without decades and hundreds of billions of dollars of capital investment.
Andy Jassy's career arc makes him the ideal CEO for this moment. He spent 18 years building AWS from a whiteboard idea to the world's most profitable cloud platform. His entire professional identity is cloud infrastructure, and cloud AI is the biggest infrastructure build-out since the internet itself.
Amazon built the world's most expensive logistics network as a loss leader to acquire customers, and then invented cloud computing to pay for it. AWS now generates more operating income than the entire retail business, which means Amazon can afford to compete in every market it enters because the profit subsidizes the strategy.
The investment thesis today is about AI infrastructure. Amazon is spending $84 billion annually on CapEx, largely for AWS AI infrastructure. And if that spend translates to AWS maintaining its cloud share, while AI workloads grow 10 times over the next decade, the current enterprise value dramatically undervalues the infrastructure position. Amazon reported Q1 2026 revenue of $181.5 billion, up 17% year over year, and above the $177.3 billion estimate. EPS of $2.78 crushed the $1.64 estimate by 69%. AWS grew 28%, its fastest rate in 15 quarters. Operating income reached $23.9 billion. At 27 times forward earnings, Amazon is executing on every front simultaneously.
Amazon was founded by Jeff Bezos in 1994 as an online bookstore and became the defining e-commerce platform of the internet era. Today it operates through 3 reporting segments: North America, International, and Amazon Web Services. AWS is the world's largest cloud infrastructure provider with approximately 31% global market share. Advertising Services has grown into the 3rd largest digital ad platform globally. CEO Andy Jassy, who led AWS from 2003 before becoming CEO in 2021, has refocused the company on operational discipline and AI infrastructure investment.
At $2.8 trillion in market cap, Amazon is one of the world's 3 most valuable companies. It generates revenue across e-commerce, cloud computing, digital advertising, Prime subscriptions, and proprietary hardware, a diversification that makes Amazon structurally distinct from any single vertical technology peer. The 2026 CapEx commitment of $200 billion is the largest infrastructure bet in corporate history.
Q1 2026 revenue of $181.5 billion beat the $177.3 billion estimate, a 2.4% outperformance. Total revenue grew 17% year over year. EPS of $2.78 demolished the $1.64 estimate by 69%. Net income reached $30.3 billion, a record quarterly figure.
AWS segment revenue grew 28% year over year to $37.6 billion, the fastest AWS growth rate in 15 quarters. AWS operating income reached $14.2 billion, representing a 37.8% margin. Microsoft Azure grew 40%, and Google Cloud grew 63% in the same period. But AWS is growing on a larger base with the highest absolute operating profit of any cloud segment.
North America revenue grew 12% to $104.1 billion. International revenue grew 11% to $39.8 billion. Advertising Services revenue grew 24% to $17.2 billion, above the 21% consensus estimate. Amazon's chips business, Trainium and Graviton, crossed $20 billion in annualized revenue, growing triple digits year over year.
Operating income reached $23.9 billion, well above the high end of the $16.5 to $21.5 billion guidance range. Operating margin expanded 240 basis points to 13.2% year over year. The combination of AWS margin expansion, advertising leverage, and international profitability drove a margin beat the Street did not fully anticipate.
Capital expenditure reached approximately $35 billion in Q1 as Amazon accelerates its $200 billion annual CapEx commitment. Operating cash flow for the trailing 12 months was $148.5 billion. Free cash flow on a trailing 12-month basis compressed to $1.2 billion, down from $25.9 billion, as CapEx absorbs the majority of operating cash generation.
Q2 2026 guidance calls for net sales of $194 to $199 billion, implying 16 to 19% year-over-year growth. Operating income guidance of $20 to $24 billion brackets the Q1 level, signaling margins should hold as infrastructure investment scales. The guidance midpoint is at or above prior consensus.
Andy Jassy joined Amazon in 1997 and spent 2 decades building AWS from a single internal project into the world's dominant cloud infrastructure platform. He became CEO in 2021 following Jeff Bezos's transition to executive chairman. Jassie's tenure has been defined by operational cost discipline, including significant 2023 headcount reductions and an aggressive pivot to AI infrastructure as the central growth driver of the next decade.
Analyst consensus heading into Q1 2026 was approximately 62 buy ratings, 2 holds, and 0 sells, among the most unanimous bullish stances in the S&P 500. The average price target was approximately $295, representing 12% upside from the pre-earnings price. The 70% EPS beat triggered a wave of price target revisions upward post-results.
The bull case among analysts centers on AWS re-acceleration. At 27 times forward earnings, Amazon is pricing in AWS growing above 25% through 2027. The market had assumed AWS growth would moderate given the large base, but the 28% Q1 print, the fastest in 15 quarters, resets the baseline. Analysts argue the demand signal from enterprise AI workloads is pulling forward AWS revenue that was previously expected in 2027.
Goldman Sachs maintained buy with a $310 target, citing AWS margin expansion to 37.8% as evidence that AI infrastructure investments are generating high-return workloads. The key observation: every dollar of AWS CapEx is increasingly backing GPU-intensive AI workloads that price at a premium to commodity compute.
More cautious analysts note that the 70% EPS beat was partly driven by favorable tax items and mark-to-market gains on equity investments, not purely operational improvement. If the Q1 earnings quality concern is valid, the normalized beat may be closer to 30%, which is still exceptional, but reduces the magnitude of the upside surprise.
The Q1 consensus takeaway: AWS at 28% growth is the story. The chips business at $20 billion annualized run rate growing triple digits is an emerging second narrative. If Amazon executes on both AWS and custom silicon simultaneously, the sum of parts valuation, cloud at 35 times earnings, retail at 15 times, advertising at 25 times, implies significant upside from current levels.
The bull case is an AWS compounding argument. At $37.6 billion quarterly, AWS is generating $50 billion in annualized operating income at 37% margins. As AI workloads price at a premium to commodity compute and as Trainium custom silicon cuts inference costs, AWS margins could expand toward 45% over a multi-year cycle. Each margin point is $2 billion in operating profit.
Advertising at $17 billion quarterly is approaching $70 billion in annual revenue. Amazon advertising is superior to Google and Meta, capturing consumer intent at point of purchase, not just awareness. As Prime Video ads scale and international penetration grows, advertising becomes the third leg of a high-margin portfolio alongside AWS and subscriptions.
The CapEx cycle is a feature, not a bug for long-term holders. Amazon spent aggressively in retail infrastructure from 2010 to 2018, creating an unassailable logistics moat. The same dynamic is playing out in AI infrastructure. $200 billion in 2026 CapEx builds compute capacity that will generate returns from 2027 to 2035, compounding returns beyond the investment horizon.
The bear case starts with free cash flow. At $1.2 billion in free cash flow on a $2.8 trillion market cap, Amazon has a free cash flow yield near zero. Operating cash flow of $148 billion is reinvested into infrastructure. If AWS growth decelerates below 20% while CapEx holds at $200 billion, Amazon will generate negative free cash flow, a significant risk for any company at 27 times forward earnings.
AWS competitive position is not permanent. Google Cloud grew 63% versus AWS's 28%, a gap widening for 6 consecutive quarters. Google's Gemini ecosystem, aggressive GCP pricing, and AI-native startup momentum could structurally shift cloud workloads away from AWS in ways not reflected in current consensus models.
Tariff exposure is underappreciated. Amazon's marketplace depends on Chinese sellers who are marginal price setters across millions of categories. New tariffs on Chinese goods could reduce selection, raise prices, and compress third-party seller unit economics, slowing the 15% unit growth rate that management cited as the highest since COVID lockdowns.
The EPS quality question matters. Net income of $30.3 billion includes mark-to-market gains on Rivian and other equity investments that are non-recurring. If normalized operating earnings are lower than reported, the forward multiple is higher than it appears, reducing the margin of safety at 27 times earnings.
The cloud peer comparison, AWS at 28% versus Azure at 40% and Google Cloud at 63%. Amazon leads in revenue but is the slowest growing hyperscaler for 6 consecutive quarters. The valuation discount to Microsoft, 27 times versus 28 times, reflects AWS's slower growth but ignores retail and advertising optionality Microsoft lacks.
The e-commerce peer comparison, Amazon versus Shopify and Walmart. Shopify's merchant ecosystem is the principal alternative to Amazon's marketplace. As Shopify grows fulfillment capabilities and Walmart scales its marketplace, Amazon faces pressure in the mid-market seller segment, driving most third-party gross merchandise volume. At 27 times earnings, Amazon's retail moat must remain intact to justify the multiple.
Meta is the advertising peer. Both companies are AI-driven advertising platforms with distinct data advantages. Amazon at the point of purchase, Meta at the point of social engagement. Meta's advertising efficiency, driven by Llama AI, is growing faster than Amazon's. Amazon's advertising is tied to product discovery, sustaining a conversion rate advantage social advertising cannot match.
Microsoft is the total enterprise peer. Both are cloud, AI, and productivity platforms. Microsoft trades at a similar forward multiple despite slower revenue growth, reflecting higher operating margins and a mature capital return program. Amazon's reinvestment model creates more optionality but less near-term earnings predictability, a trade-off the market continuously reprices.
Pre-earnings options positioning was modestly bullish. The put-call ratio settled near 0.72 in the week before results. Despite initial after-hours volatility following the print, institutional call buyers targeted the $280 and $300 strikes for June. The positioning suggests the market expected a beat but underestimated the magnitude. The 69% EPS outperformance was beyond most probability distributions.
Post-earnings options flow skewed heavily bullish. Call spread buyers positioning for AWS re-acceleration in Q2 significantly outnumbered put protection buyers. The signal embedded in this flow, institutional investors with visibility into AWS enterprise pipeline are positioning for continued above-consensus growth, not a mean reversion to slower rates.
Insider activity at Amazon is structurally minimal. Amazon has no dividend and no formal share buyback program. The company returns capital exclusively through reinvestment. CEO Andy Jassy has minimal open market transactions. The $200 billion capex commitment for 2026 is management's operative signal. A bet of this scale requires confidence in AWS demand visibility, extending at least 3 years forward.
The absence of buybacks is a feature of Amazon's capital allocation philosophy. Every dollar reinvested in infrastructure is expected to generate higher returns than a buyback. The AWS operating margin at 37.8% validates this model. The infrastructure spending of prior years is now generating exceptional returns. Investors who trust the model accept low near-term FCF in exchange for compounding infrastructure returns.
Amazon delivered a clean beat, EPS 70% above estimate, AWS at 28%, its fastest growth in 15 quarters, margins expanding. The AI flywheel, Trainium cuts compute costs, lower costs drive AWS adoption, AWS funds more infrastructure, is compounding.
Risks are real, CapEx treadmill, AWS competitive pressure from GCP, tariff exposure. At 27 times forward earnings with near zero free cash flow yield, the multiple demands execution. Watch AWS growth and TTM free cash flow recovery as the two critical metrics. Financial data and charts sourced from Financial Modeling Prep. Charged alpha is for informational and educational purposes only.